and your 2020 Toronto Crew President. We are so happy to have all of you join us online for today's signature event. This event was originally scheduled for April and for obvious reasons postponed, and we are so excited to be able to bring you this event now in a virtual format. For all of those joining today, both members and non-members from the industry, the mission of Toronto Crew is that we are dedicated to helping women excel, influence, and lead throughout their real estate careers. And over the past several months, our board, leadership teams, and committees have been hard at work to transition all of our much-loved programs to a virtual format. We have been very creative in figuring out ways to deliver programs of high value to our members, sponsors, and the industry. I'm proud to share that since the start of the year, we have been able to offer over 20 events ranging from webinars, book clubs, crew coffees, virtual happy hours, professional development and learning opportunities, personal branding sessions, lunchbox sessions for our members' children, and even a virtual cooking class to support a local restaurant. And there is more to come. Our leadership teams will be taking the summer months to plan high quality programming to be launched in the fall, and over the summer, we will continue with our virtual coffees and drinks so we can stay connected. So stay tuned, as we will also be offering an exclusive opportunity for our members and sponsors to get out on the green to golf with fellow members. While it has been an interesting and challenging time for our chapter, we can say that we are committed to supporting our members now more than ever. And it is times like this where we really appreciate and understand the value of having our crew. I would now like to address a few housekeeping items. This session is being recorded and everyone is on mute and without camera. We do have a chat function where you can say hi to the group as well as to others that are joining us live. And there's also a Q&A function. So Dr. Shenfeld will be speaking for about 30 minutes. And I'm going to pop back in to address questions from our audience. So be sure to send them through the Q&A function, which is at the bottom of your screen. I would now like to take a moment here to thank our 2020 sponsors as displayed in this presentation. Your sponsorship allows us to continue to deliver relevant and important programming for our members, and even through these challenging times. And we are very appreciative of your support for Toronto Crew. So thank you. A special thank you goes out to our signature sponsor, Oxford Properties, for bringing us today's event. I would like to introduce Kim Train, Director of Platform Services at Oxford Properties. Kim is also the President-elect for Toronto Crew, and she's going to join us now to introduce our guest speaker for today's event. Kim, over to you.
Thanks, Farah. So as Farah said, my name is Kim Train, and I am the 2020 President-elect for Toronto Crew, as well as the proud representative from Oxford today. We are thrilled to be the signature sponsor for the 2020 Economic Update. Oxford is the real estate arm of OMERS Pension Fund and is the owner, developer, and manager of assets worldwide. Established in 1960, we manage approximately $60 billion worth of assets on behalf of our co-owners and investment partners. Oxford portfolio encompasses office, retail, industrial, hotels, and multifamily residential, and spans more than 100 million square feet in global gateway cities across 4 continents. Our long-term approach to real estate investment aligns our interests to our customers and the communities in which we operate. I am very pleased to introduce Avery, our keynote speaker for today's event. Dr. Shenfeld gave me the permission to use his name, Avery, so I just wanted to say that. Avery is the Managing Director and Chief Economist at CIBC. Having been with the firm since 1993, he holds a PhD in economics from Harvard University. He's one of the country's most sought-after commentators and has consistently been ranked as one of the top economists in a survey of Canadian institutional equity investors. Avery follows economic developments and their implications for financial and asset markets. He has received multiple awards for forecast accuracy in Canada, including recognition by Reuters as the top forecaster of the Canadian economy in 2018. He is a 6-time winner of the Dow Jones Market Watch Award for Most Accurate Forecaster in the US economy. Avery's prior background includes experience in management consulting on the economics faculty of the University of Toronto and lecturing in the summer program at Harvard's John F. Kennedy School of Government. He has addressed numerous business groups and been quoted in the media in the United States, here in Canada, Asia, and Europe. Welcome, Avery. We are keenly interested in what you are going to share with us today in these turbulent times.
Thanks very much. I'll update that intro. I was actually also the top forecaster in 2019 as well. So 2 years in a row, according to actually Consensus Economics, as well as another polling firm. So I've had a good track record. I wish I could say I predicted a massive virus would hit us and we'd be in the super in, but some years things do come out of the blue. It's bittersweet for me to be here with you today. I say bittersweet because this was an event I always look forward to in terms of the chance to actually be with you, be at a table with some of the very impressive women who work in this sector in the Toronto area, indeed across Canada. And every year was always a highlight of my calendar to do that. But I'm happy to be able to do it virtually if I can't, in fact, be there with you. And hopefully, we can look forward to a year in the future where we're back together again. But my task today is to tell you a little bit about where the economy is going, both near term, and that is the period where we're still suffering under the plague we're now in, but also thinking about the longer term. And one of the phrases you'll hear these days is that the world will never be the same. I've been doing this job for a long time, as well as I'm a bit of a student of history. And I know that in past crises, we've heard the same phrase, and it's often a bit overdone. So go back to the war to end all wars. That was World War I, and there's a reason we now call it World War I. It was obviously on number 2. When the Berlin Wall fell, I remember people thinking that Russia would become a democratic, capitalistic ally. We wouldn't need NATO anymore. That clearly didn't happen. And most recently, when we had 9/11, I remember people thinking, oh, we'll never go back to flying or working in tall buildings again. And there we are. We went back to flying, and they built a tall office building right where the World Trade Center stood that was knocked down. So I tend to think that actually we tend to overstate what is going to stick from these crises period. But nevertheless, I think there's also some interesting change that I'm going to talk about ahead. But in the here and now, we're in the middle of a very deep recession. You can see that in our forecast line, how far US real GDP, Canadian real GDP have plunged. Sort of hard to pick it up on the scale, but the nosedive in output that we saw essentially from February to April is the largest decline we've seen in Canada's history since 1930. And that first year of the Great Depression, it took a full year for GDP to decline as much as it has in the space of only a couple of months this year. But what is noticeable is that if you go back to the 2008 recession, while both the US and Canada recovered from those recessions, you can see that we actually got left with a permanent hole in GDP. If you just draw the trend line in where GDP was growing from 2000 to 2008, we never really got back to that trend line post-recession. We got back to the growth rates, but never really closed the gap. So one thing that we do expect is that this recession too may leave some longer-term scars. Typically, these are associated with spending a couple of years with low capital spending, so you miss out on some barrels of oil you might have been able to produce down the road, or factory output that would have existed from a factory that you don't now build. And you also displace people from their jobs, and sometimes they don't end up matching as well in their subsequent career. So there will be some long-term damage from this. But as you can see in our forecast, pretty quickly, we see the start of a comeback. And in fact, if you think about the analogy to a racetrack, we are seeing the roaring of the engines of the cars off the starting line, making it look, at least initially, like we're in a robust recovery. But I say look that way because appearances can be deceptive. And our view is that the next few months are going to leave us perhaps a little too optimistic about what lies ahead after that. And the reason for that is simply that the virus itself is going to dictate how much of a recovery we can get, at least until we have a vaccine in place. We haven't forgotten the lessons that we learned all the way back in 1918 when the world was hit with the Spanish flu, which killed millions of people around the world. This chart looks at the UK, but the experience was very similar in the US, that there was a first wave of the virus in sort of mid-2018, but actually it was the second wave in that case that was bigger. Now, it doesn't necessarily mean that we're going to be hit with something worse than we had this spring. We certainly hope not. But what it does tell us is that the world, until we have a vaccine in place, is going to have to be guarded in terms of how much economic activity we can open up without triggering a material second wave and forcing a complete shutdown. And although we don't expect a big second wave, what we're starting to see in some other countries is mini waves or brush fires that are forcing them, at least in given cities or regions, to pull back on some of the opening up measures of the economy. In other words, reimpose tighter restraints that are going to take a toll on economic growth in those cities or regions, and therefore hamper national growth rates for some time to come. And the other factor is consumers themselves. Even if governments don't actually step in and say that we're reimposing some of these restraints, it's not as if that Canadians or Americans are going to be unaware of the news around them, particularly if they hear that their neighbor or their coworker has gotten sick by undertaking a certain activity. They're going to shy away from that. One place we can look for impacts like that is China, simply because they are several months ahead of Canada in terms of having gotten through their first peak of the disease, getting the numbers way, way down. What we've seen is a nice recovery in Chinese industrial activities, but consumer activities, not quite so much. And part of this we see in the traffic data in China, where there's more driving during the week than on the weekend. People are still reluctant to venture out too much for fear that the contagion will come back. We're already starting to see that actually in some US states in the South, where governments seem to have a fairly cavalier attitude about coronavirus for reasons that we in Canada can't really understand, because their cases are peaking in places like Arizona and Texas. But the public in the last week or so has actually started to stay away from the hair salons and beer halls and so on, for fear of catching the disease. So consumer caution is going to remain at least somewhat of a headwind. But the biggest issue is really that too many sectors are not going to join the reopening of the economy. And those sectors, either fully or only partially, and those sectors account for a fairly significant part of economic activity in Canada. So many of us are sitting in our home offices and carrying on our jobs the way we normally did, because we can work solo however much we dislike it. But that's not obviously the case for someone who worked at, for example, a nightclub, a convention center, a crowded bar, any sort of venue where an indoor crowd is part of the action. Essentially, we expect them to remain shut down until a vaccine or a cure is in place. And we don't expect the vaccine to be widely disseminated until, at the earliest, late 2021. And even that would be very optimistic by historic standards to get there that fast. So how big are those sectors? Well, if you look at the percentage of employment that those things accounted for just prior to the onset of coronavirus, they account for a substantial share of total employment. So in Canada, for example, if we assume that sectors like accommodation, food services, sports, entertainment only get back to 75% of where they were. And remember that if we allow restaurants to open indoors, we're going to have distanced tables. So the restaurant is going to have to run sort of half full. That likely means lesser employment. For Canada, that accounted for about 2.5% of employment. And that's not the total challenge, because we have factories that may open, for example, and not have a problem with distancing among their workers, but they're going to face, in many cases, depressed global demand because they could be suppliers to some of the sectors that are themselves seeing depressed global economic activity. So what that means in terms of when we think about Canada, for example, good news is that we drew this chart in April, and so we've let it sit for a couple of months, and so far the numbers still look about right. We expected the unemployment rate to peak around 14%, but when we look at the average for next year, taking into account the sectors like convention halls that might be closed, restaurants operating at half capacity, and so on, we're looking at the unemployment rate to be still sitting at around 8.5%. And that compares to where we were in February before this hit of around 5.5%. And another way of looking at it is 8.5% was about as high as the unemployment rate got in Canada in the last recession. So if you want to describe the Canadian economy, where it is, where it's going over the next year, you could say that we are recovering from depression-like conditions in April to recession-like conditions a year from now. So yes, we're going to see some nice growth rates in the very near term, but after that, it's going to be a very long horizon to get back to the kind of unemployment rates we had in February, which is only a few months ago. So a deep, very short actual recession, which is the period of decline, but unfortunately a long, long road back to normal economic conditions. So if you look at this graphically in GDP terms, and here I've just blown up the chart I showed you earlier, it is true that by the end of 2021, total economic output in Canada could be roughly on par with where it was in late 2019. But that is actually not a return to normal, because normal really would see the economy growing at just under 2% a year over that period. That's the yellow line on this chart. So in fact, the gap there between the red line and the yellow line is the GDP equivalent of those missing jobs. It's the missing growth that we should have had and that we need to have every year in order to sustain a full employment economy. So one thing they say is misery loves company, and I know that the real estate industry is all very localized. So the good thing is that misery loves company, so everyone isn't so miserable, because this is a shock that pretty much hit all provinces in Canada. There are some differences. You can see that in the real GDP growth column, for example, we have a much bigger hit in Alberta and Newfoundland than in some other parts of the country. That really reflects the share of their economies tied up in the energy sector, which is seeing really a double recession here, a recession that would have taken place anyway because of a price war that broke out between the Saudis and the Russians, which would have driven prices down anyway, coupled with, of course, the effect of depressed global demand for oil. And even though oil prices have come back, no one in the industry is going to cheer a $40 a barrel price, or even 45, which we expect to average next year. That's still far too low to rekindle the capital spending that really creates a lot of the jobs in the energy sector. At the other end of the spectrum, we have Manitoba actually being the lightest hit province. That reflects two advantages that that province has. It was actually one of the lighter affected provinces in terms of actual COVID-19 cases. Now, that's also true in some Atlantic Canada provinces, but the difference is that some of those Atlantic Canada provinces, like PEI, for example, are heavily dependent on tourism. So they're still missing out a lot of spending by the non-locals, the off-the-island people who come every year from the US and elsewhere. So not doing quite as well as Manitoba. Nothing wrong with Manitoba, but doesn't tend to be a tourism hotspot, let's face it. So they're doing a little bit better than some other parts of the country. If you compare Quebec and Ontario, we do have Quebec doing better than Ontario. They actually were able to open up their economy some weeks earlier. They took a gamble. It turns out so far that gamble paid off in the sense that they haven't seen cases soaring again. And that extra month of activity actually is so significant, it adds up to a difference in terms of GDP growth this year. But there's no province in Canada that looks particularly good this year. And if you look at growth rates, you can see for the country as a whole, down 7% this year, up 5.7% next year. So not a great combination for the 2 years put together. The market, one of the things that actually is easy to forecast these days is interest rates. I've been doing this job a long time, and I always have people start off a sentence with, well, there must be a lot of uncertainty out there. And I usually joke around that I never recall a period where someone said, there's a lot of certainty out there. But actually, in terms of our interest rate forecast, I've never been more certain about that forecast, which is that with such a big economic hole to fill, and really no prospect of getting back to normal until that vaccine is in place, we can predict with a high degree of confidence that the Bank of Canada and the Federal Reserve will be keeping interest rates right where they are, not just for this year, but for next year, and in all likelihood, 2022 as well, because it's going to take quite a while after a vaccine is available to have it disseminated to billions of people around the world and to rekindle then the kind of economic activity that we were missing in the next 2 years. The bond market has actually been assuming something a little differently. You can see in this chart, which I drew a week or so ago, that the market was pricing in 8 basis points of hikes by the Bank of Canada. And other than Australia, if you looked at these other charts, there was pretty much close to zero for everybody. So the market was generally assuming that for some reason, Canada would be one of the earliest to hike rates. I think that's a mistake. It relates perhaps to the fact that we did hike earlier after the last recession, but that recession was much milder in Canada than it was in the US or Europe. We didn't have the financial market failures that they had in those two jurisdictions, nor did we have the US housing crash to deal with. I think this cycle, we're all in the same pain. And we suspect that the Bank of Canada will be equally slow in raising interest rates. And the reason this matters is because for a while, the market was pricing that into short-term interest rates, as well as a gain in the Canadian dollar that we think is a bit misguided. We don't see the Canadian dollar rallying from current levels, at least not due to an earlier than expected tightening by the Bank of Canada. It is true that monetary policy isn't the only source of stimulus. And so some people might say, well, if we stimulate a lot with fiscal policy, maybe the economy gets going a little faster than some others and does allow the Bank of Canada to raise rates earlier. I would caution that this is a case where virtually every government is doing something similar to Canada. And we are far from being the most profligate in terms of the kind of particularly direct stimulus that is actual spending relative to the size of our economy. In fact, if anything, the US has done a little more than us, as has Japan and Germany and Australia. We're sort of in the middle of the pack in terms of that stimulus. And therefore, again, no reason why we can ease up on monetary policy stimulus for a long time to come. So for the real estate sector, one key here is that short-term financing costs are going to remain very, very low for the foreseeable future. What about long-term rates? Well, if you go to this is a table that might be a little hard to see. Some of you may have to squint or get very close and intimate with your screen. But what we show here is our full rate forecast for Canada and the US going out to 2022. And you can see that we do have 10-year rates and 30-year rates creeping up in both countries, still extremely low by historic standards. I mean, we're talking about 10-year Canadian government bond yields at 1.25%, and that's at the end of 2021. It's a very low yield by historic standards. But they will tend to drift up for a couple of reasons. One is, of course, long rates, when they hear a vaccine has come and is starting to be disseminated, they will look ahead to eventually higher short rates in 2023 and start to price that in. As well, the government of Canada seems to be shifting its tune. This is very recent developments. Minister Marneau seemed to be hinting that maybe with rates so low and borrowing so high, the government would be prudent to lock in more of the debt with longer term financing than the usual mix. And if so, that might put as well a little bit of pressure on long-term borrowing costs. But the Bank of Canada, one thing it does not want to see does not want to see 5-year mortgages moving up. And if 5-year bond yields started to escalate earlier than they would like to see, in other words, before the economy is really back in gear, I wouldn't be surprised if they announced a direct target for 5-year Government of Canada yields, reinforced by their willingness to buy 5-year bonds as need be to hold them down. They do not want to see the front end of the yield curve where the mortgages are, for example, for households moving up, because that's really how low interest rates are going to stimulate some economic activity. Some people are worried, can the government afford? I get this question a lot. Can the government actually afford to do what they're doing? And yesterday, we had a one-notch downgrade by Fitch of Canada's debt rating from AAA to AA high. In other words, from a perfect score to still an extremely good score relative to other countries. I would note that yesterday also saw the IMF release its forecast, and included in that global forecast was a projection for gross debt as a share of GDP for various countries. And I would note that Canada's gross debt as of 2021 will still be much smaller as a share of GDP than either the average of G20 countries or the US gross debt to GDP. So actually, on a relative basis, we're still in pretty good shape. And even on an absolute basis, all this government borrowing is not as problematic as some people might make out. I had asked the question, how are we going to pay for this $300 billion deficit? You know, how do we ever pay that $300 billion back? Well, the answer is we don't pay it back. We never pay it back. The reason that governments are differ from you and I, or even the companies that you work for, is essentially governments live forever. When the 10-year bond that they issue to finance this year's deficit comes due 10 years from now, they will simply roll that over into a new 10-year bond. The future taxpayer never has to repay the principal. Now, what they do have to pay is the interest on that debt. But think about it. The government is going to borrow this year an extra $300 billion. And just to make the math easy, because I'm not very good at math after all, let's assume an average interest rate of 0.5% on that debt, which is around where the yield curve would give them today. That is an additional annual interest cost then of $1.5 billion. Suppose they do it again next year, and then the deficit falls off after that. So another $1.5 billion in extra interest payments, that's $3 billion. Sounds like a lot, but it's actually only 1%. It's actually less than 1% of annual government spending in a normal year. Moreover, the economy will start to grow. And as the economy grows, those extra interest payments as a share of GDP actually come down because the economy grows faster than those interest rates compound. So this is a bit of a complicated chart, but essentially it's showing that as long as nominal GDP growth is 4% and you borrow at 0.5%, or in this case, the chart was drawn with 0.6%, the interest and accumulated interest on the interest will grow more slowly than GDP. So when I asked how can we afford to do this, the right answer is we couldn't afford not to do this. Without it, the depression could have continued. We would have had a rain of defaults in the household sector and business sector, making it much more difficult to reopen the economy as the virus faded away. And the fact that governments of every political stripe across the world have done the same thing tells you why this was such a necessity. The equity market seems to think everything's great. We're not so sure about that. Historically, even recessions that last only a quarter or two, it takes about 10 to 14 quarters for earnings to reattain their peak. So this is really equity markets just pricing in a very low discount rate on future earnings, because I think those future earnings are going to stay well below where they were in 2019 for some time to come. So let's take a look then at what all this means for your sector, the real estate sector. I'm going to start with housing. And we have, in addition to suffering a recession, which is never great news for housing, we have an additional factor in this particular recession, is that we've lost one of the most important fuels for the housing engine in Canada, and that is immigration. We're still going to let in the people who got approved prior to March, but after that, we're going to see the immigration numbers slow to a trickle. And in particular, we're also expecting to see many fewer non-permanent residents show up to go to school and take on temporary jobs. And all of this is quite meaningful as a share of the population. Immigration on a net basis was accounting for anywhere from 0.5% to 1.5% of population. Those are big numbers with a lot of housing units and rental units in particular, because new immigrants and non-permanent residents often start out as renters, that's a big drawdown from the fuel from the rental and housing market in Canada. There is a potential wild card here that could offset it, which comes on two parts. One is there are millions of Canadians living abroad. Estimates, and these are only estimates that we pulled together from various sources, suggest that there might be 3.5 million Canadians living abroad. And if those Canadians were a province unto themselves, it'd be about the same as Alberta in terms of the population. Now, we don't expect all these Canadians to suddenly decide, yep, Canada, I'm a Canadian citizen, and now I'm going to move back. But remember that a good chunk of these people are in Hong Kong. We estimate about 350,000. That's a pretty big number, which could create some housing demand. Some of these people already own properties in Canada, but if the political situation in Hong Kong turns ugly enough, maybe some of these people will come back. And in addition, we used to have a lot of Canadians draining out of Canada to go to the US, and the US is getting tougher on visa requirements, so we may, on a net basis, do a little bit better than that. But nevertheless, we do expect to see the construction industry slow. This year will be slower than normal. We had a month where essentially construction sites were shut down. And although they're back up and running, the social distancing rules that are in operation at construction sites are straining productivity significantly. You know, it does take two strong young men and women to lift those big boards and so on. And it's kind of hard for them to do it standing 6 feet apart. But also they can't ride up the elevator together. There's all sorts of things that are slowing the workforces down. So we expect actually an exaggerated drop in housing completions this year, which actually is good news because the market's a little soft. So maybe that will help on the pricing side. But lower housing starts because of the depressed demand, including the depressed demand from immigration, means that the whole construction sector will be operating at a slower pace when we get into 2021, and you can see that numbers look a little different in different parts of the country, but it's pretty much the same story. Things aren't going to be as hot as they had been pre-crisis for some time to come. Some people are worried about another aspect of housing, which is the actual health of the people who are living in those houses, particularly their economic health. And one of the concerns I hear is that one reason that we haven't seen a big wave of defaults yet on mortgages is that anyone who ran into trouble quickly rushed to their lender, deferred their mortgage payment for 6 months, and so their problems won't show up until the 6 months are up. And while there's some truth to that, when we dug into the numbers, actually, they look a little more encouraging. So number one is, remember that in the first 6 months of recovery, we do expect a lot of the jobs to come back. So some people made the absolute sane decision that they're going to be unemployed for a few months, but their job will return because it's in a sector that is going to reopen, and then they'll be able to start paying their mortgage again. If you actually look at who did the deferrals and you distribute them by credit score, they're not overwhelmingly people who entered this period with a very marginal credit score. They were generally not that dissimilar to the whole portfolio of mortgages in Canada, other than that the very highest credit scored people did not tend to be among those that deferred. And also digging into our own data, what we found is that some people deferred and hadn't lost a job, just thought it was 6 months free no interest. Didn't really understand that they were adding to their principal, for example, by not paying those 6 months. As we're contacting those people, many of them are deciding to resume payments. So the 15% deferral might exaggerate actually how many people were in difficulty. So that's pretty good news. We're not expecting a huge blow up there. And in fact, because Canadians are not spending the way they used to, people's credit card balances are lower, their lines of credit balances are lower, all those things are lower because frankly, a lot of the spending you might like to do, you can't do. I can't go to Europe even though I want to. I can't go out to a restaurant. I can't even treat one of you to a business lunch. So the net result is that credit actual use is coming down a bit. And with lower interest rates, we actually expect that scary number, the percentage of household income going to debt service, to actually drop between here and 6 months from now when those mortgage payments are set to resume. So the credit situation not as bad as maybe some people fear. One thing we do expect to see in the housing numbers, though, is some weakening in housing prices, particularly in the kind of units that were rented because of that population shift that I talked about, depressing rental values and therefore depressing to some extent what investors would be willing to pay for the units. We're going to see some exaggeration in that. These numbers are a month old. I didn't get a chance to update them. But what they show is there's a big difference between average selling prices and the benchmark index. So I caution you that sometimes people will talk about average home sale prices in a given month. But if we have a swing to selling more smaller units and the bigger, more expensive houses are sitting on the market longer, which is exactly what we've seen lately, the average price will drop because of the mix change. So you have to watch the benchmark price. You can see it's leveled off on a year-over-year basis. It's not growing, and I think on a monthly basis we might be seeing some actual declines a bit in the months ahead, but not as bad as what we're seeing in that unweighted or index. Let's take to office space, because one of those world will never be the same statements you hear is that all those empty office towers are going to stay empty, that we're never going to go back to working in office buildings because we so love working from home. You can tell in my voice there's a little bit of sarcasm there. You know, I like to say that Aristotle once wrote that man is a social animal. Today we'd say men and women are social animals. But I think he wrote that after working from home too long and realizing that there is a reason we gather together to work. It's more fun. And in some industries, it's also more productive. Now, there was a slight trend, as you can see, from 1997 to 2010, for example. These are US data. We did see an upward creep in the number of people working from home. A lot of that is in the tech industry. And I do expect that with this experiment of having just about everyone working from home in that sector, it's going to stick more in that industry. But in other industries, I see two problems. One is the lack of collaboration, which is important for creative thinking in business. That's one problem with retaining this. And the other problem is turnover. Right now, things may be going fine because you're working with colleagues you worked with in person. But try bringing new employees into your mix who you've never met, have them start work online, explain to them their daily tasks without sitting beside them for hour after hour. And I think you're going to find that it doesn't work well at all. Remember that the technology to work from home is not new. We could have had a Zoom meeting 5 years ago. Zoom is not an overnight success. It's been around for a decade. And my view is that offices will come back into demand with only a slight extra hangover from this in terms of people working from home, at least full time. We're probably going to be more tolerant of people working from
off screen for a minute. Thank you.
All right. Okay, so we're all here, including me. So I don't think we're all going back to working from home. And so I think most office demand will come back. Okay, let's go to the next slide. Talk about retail. That's not so good because this is a case where, unlike working from home, which was only a very slight trend, online retailing obviously was a growing trend. I don't think online is going to retain all of the activity or nearly all the activity it's picked up now. I'm finding my own tomatoes don't look so good if I order them online. I'd rather pick them myself at the store. But there is a cohort of people who have tried ordering from home, ordering online for the first time and may have decided they like it. So I think this is we're going to end up with a smaller share of e-commerce than we have now. But a higher share than we had in 2019. And of course, we were already seeing some pressure on retail space. We were actually filling in some of that by converting retail space that sold goods to retail space that had services, everything from nail salons to yoga studios. We're taking up a lot more conventionally goods-related space. But I think we are going to leave this cycle with a legacy of empty space, not just because there'll have been an extra shift to e-commerce, but also because the reality is that not every restaurant, hair salon, and so on, and venue is going to make it through this downturn. Space that's leased out for wedding receptions and so on, a lot of these things are going to go bust, and it is going to take a long time, unfortunately, to fill in that space. What about in industrial space? I think one of the things some people talk about is we're going to bring back all the foreign manufacturing to Canada again, because we're not going to deal with China anymore. Globalization is going to completely reverse. That too is a gross overstatement. We're not going to make t-shirts in Manhattan the way we did in the 1920s. We're not going to certainly grow our own oranges in Canada to make orange juice. But the reality was that globalization had slowed a little bit. And the place that it slowed was in the degree to which companies manufacture things using components from somewhere else. You could see that if you looked at the foreign value added, that's the foreign content in OECD exports, it had started to come down since 2011. And what some of that was a really rebalancing of the need to have, for example, activities in a low-wage country where mechanization has meant that actually some of these industries don't use a lot of labor and can be reshored to closer facilities because they don't use a lot of labor. So we're not creating a lot of jobs in bringing those things back, but we are reducing the dependence on trade and therefore creating a little bit more demand for industrial space. So again, an evolution here, not a revolution. The one area may be that we decide that we don't want to rely on China for healthcare goods. We want to produce more of those crises type materials, maybe defense equipment more locally. The US, for example, 20% of what they import from China could be classified as either telecom, defense, or healthcare. That may be where we see a little bit of a shift away from China. But some of that is just going to go to other low-wage countries where the US has a more solid relationship rather than all the way coming back to North America. But nevertheless, another trend that we had seen that is supportive for industrial space, people often talk about the need for warehouses for Amazon, but there also may be more need for warehouses for manufacturing in general to store more of their inventory locally. The trend in prior decades up to about 2005 was leaner and leaner use of inventories, just-in-time manufacturing, all the rage. But first of all, when you're in a very low interest rate world, which we seem to be stuck in almost permanently, the cost of carrying inventories or financing them is not that great. And companies have started to worry a little bit more about the trade-off in a plant going down somewhere in the world that produces one tiny little part for you, stalls your production line in Quebec or Ontario. Is that really worth it? And so we are seeing a trend towards carrying a little more inventories relative to sales, which is supportive for industrial space. So not so good for retail. I don't think it's a disaster for office, maybe a bit of a positive trend on the industrial real estate side. If we go to the next slide, it's a bunch of warning words. I would say something about tourism. I didn't talk about hotel space. I think it's a long time before hotel demand comes back. That was a trend, though, that if you go back pre-crisis, tourism for individuals was actually growing much faster than GDP. Growing incomes around the world were leading to actually an acceleration in tourism. And just like after 9/11, eventually all the flying came back, I do think it will come back here. So hotels that are based on individual tourism, I think have a full recovery ahead. I do think that conventions will come back as well. We would like to actually meet you in person, shake hands and so on. Maybe we won't shake hands, maybe we'll just bow like the Japanese, but we're gonna wanna have personal contact. The one area I could see being a bit depressed is internal business travel. Companies are experimenting now with the use of technologies like this one, and you can see they're not perfect. But I think coming out of this, they will question, why does the board of directors have to fly in from all over the world for their 2-day meeting? Maybe they could do that twice a year and hold the other meetings on Zoom. So I do think business travel will come out of this for internal business travel purposes a bit lighter, and therefore a bit of an impact on hotel space that might last longer than the virus itself. So with that, I'll turn it back to you for questions. Thanks very much.
All right. Thank you, Dr. Shenfeld. What a great presentation. I think very different than some of the presentations we've heard of yours in the past, and quite interesting times we're in right now. We did get some questions coming in from the audience, so I'm going to address the first one here. I think I closed that document. Just give me one quick second. And I will get that one that was actually sent to us by email. Okay, here it is. Since a vaccine is more than a year ago, or possibly away, or possibly more, and a second wave is expected in fall, what do you think will be the impact on the market? More like the crash of 2008 that came around due to poor financial decisions by big players, or a market that would be able to bounce back quicker than 2008 to 2010?
So I think a lot of this is going to depend on something I'm not such an expert on, which is, I think I was introduced as Dr. Shenfeld. I wish I was a real doctor now, because being a doctor of economics doesn't really help me in infectious disease. But I've been reading a lot about this, obviously. The answer very much depends on what you think of government's ability to tamp down the second and third waves before they get out of control. So the good news is that we are seeing this done in other countries, and I would say so far fairly successfully. So everywhere from South Korea, in Seoul, in Beijing, in Berlin, we've had countries that had got the coronavirus down to very low levels, so they had completed their first wave, started to see the makings of a second wave, and by isolating small parts of their country, in effect, and stopping a few kinds of activities, they were able to get the numbers back down again. So if that's what we're facing, it is going to constrain economic activity, because each time we have to do this, if you add it up across the country, those mini shutdowns do add up, but they're no big disaster. On the other side of the coin is, if this is managed by Donald Trump's team, from what I've seen from them, I have less confidence. So I'm a bit more worried that in the US, they're not taking this seriously enough and could be caught off guard by big second waves. They are not in a second wave now. They are in their first wave in many states, and they have not successfully tamped that down. So there's a growing gap, for example, in the chart on new cases per capita in Canada and the US. They weren't that different early in the crisis. They look very different now. And the US is probably at a greater risk of having to take a more material backstep in economic activity because of a second wave. So the short answer is we don't know. And it really is going to depend on how well this is handled. If it gets out of control, we're going to be back in full shutdowns in certain economies, and that would be obviously a huge setback for financial market sentiment.
So we should all stay home and wash our hands.
We need to. I think the lessons we're learning from other countries is that masks help. To some extent, the answer is staring us in the face. It's what's in front of the faces of the people on the streets in Tokyo and Korea, which are masks. When they go inside, they're wearing masks. I'd like to see masks made mandatory. Only a government can really do that, and I think we should do that. Indoor masks should be mandatory. That would help ward off a big second wave, and we need to just be careful about maintaining some social distancing as we go about our daily life. And then there is a lot of the economy that can come back if people are wearing masks and not having lengthy conversations, a foot apart. But I know that in the office space, it's a huge challenge, everything from air circulation, elevators, and so on. It's going to mean that we're not all going back to our offices that quickly, because crowding the office probably is a bad idea. We can use some of the office space, but I think full use, we need the vaccine in place.
Got it. Okay. We do have another question here. So it says, with unprecedented times, do you foresee more distressed debt in the real estate market, and how are banks preparing for this?
So we did get a hint of this. If you saw the last quarterly earnings numbers from banks, they all had quite large provisions for future losses. And those aren't actual losses. They're not even non-performing loans. Most of them are just looking at the economic climate and projecting that and saying, well, that usually leads to a big problem, and we're going to allow for some of that problem, even if we can't identify exactly where those credit losses are. The way I'm thinking about it is, it's not as bad as you would expect with a 13% unemployment rate, because that unemployment rate isn't going to last that long. It's going to come down before we really have the same degree of stress we would normally get. but I would say it's similar to what we'd have expected to see on a kind of recession that took the unemployment rate to 8.5%. That's where we think it'll be a year from now. And we're deferring it a bit because governments are out there lending money to companies and helping them tide through this sort of hibernation in the economy. But I think it's the reality is that not everything is going to wake up in great shape. And the real estate sector is just a part of that story. There's going to be projects launched that were marginal or and then get tougher to fill. There's going to be tenants who go under, creating stress for the landlords. These are inevitable problems in a recession this deep. And lenders, what are we doing? We're trying to work with our clients to extend term a bit so that we give people some time to make it back. A lot of loans it's not just mortgages that were deferred, but other types of loans, payments were deferred. But these are for credits that obviously have a good long-term story beyond that. Otherwise, we're going to have asset sales and other ways to try to raise cash or equity to handle the debt burden that has been taken on.
Okay. Another question we have here, just give me a second, was that someone wants to know why the stock markets are not reflective of the depression recession status we're experiencing.
So I'll give you 3 reasons why it's not all crazy. Number one is, remember that your finance professor told you that the value of a stock was not based on some PE multiple, because that's 1 year's earnings. They never told you to look at 1 year's earnings. They always said it's the present value of a future stream of earnings or dividends or net cash flows, depends on the model you use. And so what the first thing that equity markets are saying is, look, this too shall pass. And if this is a company that's going to exist for 20 years, the last 17 of those years may be unaffected by this virus. And so that's step number one. Step number two is, if taking that present value, I use a lower discount rate because long-term interest rates are lower, that's going to raise that present value somewhat and make up for the first few years of earnings being bad. And then the third factor is, if you look at the S&P 500, a lot of that recovery that we've seen since March is narrowly based. It's in companies that, if anything, are booming because of this crisis. And it's not just Zoom. It's, I think Amazon, judging by the packages coming down my street, is doing just fine. The grocery stores are booming because you're not eating at a restaurant. Normally, a grocery store sales, a good years, they grew by 1%. In many cases, they're up by 15%. So part of this is narrowly based. Part of it is the lower discount rate. And part of it is an optimism that this will pass. Even with all that, my view is maybe the market's a little too optimistic, that they're reading these recent signs of a rebound and sort of projecting a V-shaped recovery and not allowing enough for 2 things. One is that it might take a long time to get earnings back to peak. But the second thing is, the stock you buy, that company has to live to see the brighter day 3-4 years from now. So are we underpricing the risk that the company you're looking at will either have to raise new equity and dilute your shares, be taken over by the bondholders, sell assets to private equity so they disappear from the market? There's lots of ways then that you don't live as a shareholder to get the full benefits of the recovery. Even just dividends and share buybacks are likely to be down. So you're not getting the same flow. Share buybacks are a big way that in the last upcycle, companies were growing earnings per share. They were reducing the number of shares. And what we see in every recession is that the pace of share buybacks falls off significantly. So you stop getting that benefit. That's worth something also in terms of how you project earnings per share growth.
Very good. Great answer. Thank you for sharing that. I think we're kind of nearing the end of our time together. So we'll use this opportunity to wrap up. And thank you very much, Dr. Shenfeld. This was such a great session. I know such value to our members. Everyone has stayed online and engaged the whole time. And even when you dropped off, we were all anxiously awaiting you to come back. So thank you for joining us here. And we can't wait to be back in person with you for the next one, hopefully next year or soon thereafter. And thank you once again to Oxford Properties for sponsoring today's event. Thank you guys and have a good one.
Thanks a lot, everyone.
Bye. Thank you.